Let me tell you how we value stocks. I think the best example that seems to resonate with most people is thinking about buying a house. And to keep the numbers simple, let's say that someone is asking $1 million for the house they want to sell, and your job is to figure out whether that's a good deal or not. One of the first questions I'd ask is, well, how much rent could I get for that thing? Okay? So in other words, if I rented out that $1 million house, how much rent would I collect? We're going to collect $70,000, $80,000, $90,000 a year, 7, 8, 9% yield on that house. That's one way I might go about valuing it. And what's the next question you would ask? What are the other houses on the block going for, in the block next door, in the town next door? How does this compare? How relatively cheap is this relative to all my current choices? So that's what we do. We look at how relatively cheap is this business relative to other similar businesses, relative to a whole universe of choices that I have. We do that. We also go back in history, look at how this company or this house has traditionally been valued versus other ones in the neighborhood or versus other communities, and how is it being valued now. So measures of absolute and relative value, absolutely cheap, on a rental basis, absolutely cheap, or relatively cheap on all different kinds of measures that make sense to you. Now, you wouldn't use any of these measures all by themselves. If you just use relative cheapness, if some of you remember the internet bubble and you bought the cheapest internet stock, that wasn't cheap. It was just cheap relative to all the other crazy priced stocks at the time. But we use our measures of absolute and relative values, checks and balances against each other to try to zero in on fair value. So when you do this, this is actually a study we did of our valuation methodology, very, very similar to the way I just said we value a house. This is how we looked at the 2,000 largest companies in the US over a 20-year period. This was 1992 to 2012. And we ranked them on a daily basis from 1 to 2,000 based on their discount to our assessment of value using these metrics. The x-axis here is just the valuation percentile. All this means is if you were in the bottom left-hand corner and you were in the first percentile, you're the 20 companies at any particular time out of those 2,000 that measured cheapest according to our measures of absolute and relative value. You go to the 99th percentile, you would be the 20 companies that measure most expensive out of those 2,000. The y-axis is the year forward return on average during those 20 years. What this chart simply says is, on average, stocks that fell in our first percentile, the cheapest 20, averaged a 1-year forward return during those 20 years of 38%. Stocks that ranked in our second percentile averaged a 1-year forward return of about 37%. And then we drop down to this best fit line, which we always say we don't mind missing when we're making extra money. And then as we measure something more expensive, the year forward return drops. And if you were sitting in my class at Columbia and I said, hey, does anyone see a long-short strategy you might pursue if you could predict ahead of time which stocks would do best, second best, third best in order? And you did not say, I guess I'd buy these guys up here in the upper left-hand corner and short these guys in the bottom right-hand corner. If you didn't say that, I'd probably throw you out of class because it's very straightforward. That's what you should do. And by the way, that's what we do.